I'm Michael Fox, and this is the Prospector Podcast. And I have a real treat today. I have Peter Grandich, a 40-year veteran of Wall Street, former contributor to the Prospector News way back in the day. And it's good to have you on.
Yes, and it was way back in the day, but good to speak to you again, Michael.
Yes, we bumped into each other in Quebec City. You were invited to be a speaker at the mining event of the North last year, and it was good to reconnect with you. And it's good to have you on today. For my listeners who aren't particularly familiar with you, you have had a very long and storied career, and you've been very much a vocal proponent of commodities and mining stocks in your career, and I wanted to get a chance today to talk to you about exactly that, commodities and mining stocks. Let's start with the gold market. We're a year into a pretty solid run in the gold price, up from 2,000 to new records at 3,000.
Yeah, so Michael, I exited working within the metals and mining industry in early 2013. However, and then stayed focused on another business that I had, which was financial planning with athletes and the general public. But around 2018, saw what the price of gold was, which I hadn't looked at in a while, spoke about it, got called up by a young lady that had a popular internet show, and spoke more about gold. And before I know it, I got a couple calls from old friends, and I started getting back involved in gold at, just around on either side of 1,300. And I had concluded then that there was a really good chance for it to run substantially, at least back to 2,000 again, which it never really could get above in the last cycle and all. And as each year grew, and even through the COVID and all, I became so bullish by the end of 2021. For me personally, I sold all my general equities but one and put it all into physical gold on the belief, not because the world's coming to an end or not because of some monetary crisis, but the simple fact that I thought it would go up more than stocks and bonds. And it did. And what's really interesting, if we look back, because you talked about a time and period when I was more involved in the industry, since January 1st, 2000, gold has now outperformed both stocks and bonds. And what's really ironic about that, after a 25-year performance, here in the US at least, not half of 1% of portfolios have exposure to gold. Yet it was the best performing asset versus what they mostly have in stocks and bonds. So it's been a real good run. It's a round number that it got to because there is no formal resistance anywhere at this point in time. It's due, I think, for a little bit of a corrective consolidation phase, or at least it's better to have it now than if we keep moving up almost in a parabolic move, because when that inevitable corrective comes, it'll be sharper and harder and maybe more difficult to rebound from. But it's still a market that has no signs long-term or even intermediate term to have peaked.
I kind of laugh about the gold market myself personally. Like, I started raw as possible going into this. I got tossed into the deep end of the pool really rapidly, but I remember gold was trading at $280 when I first started in about 2002. And if you had told gold miners back then that gold would hit 1,000, they would have been dancing jigs down the aisles of the PDAC, imagining that, but for them to imagine, $3,000 gold where we're at today, which is, essentially almost an 11 bagger. And we all fight, we all talk about our resource stocks that we're looking for, 10 baggers, 5 baggers and things of that nature. But the commodity itself, if you bought back when I started to today, you'd be sitting at an 11 bagger and be quite happy. So yeah, I know exactly what you're saying. But it's definitely been an up and down ride, but it seems to have more legs to go. What is it about gold that seems to withstand things like cryptocurrencies and those types of investments, and give it legs where, those other investments kind of die off.
Well, first of all, I can remember being at PTAC hoping if gold could just get above 350. So seeing it with a 3,000 number is still quite amazing. But these are the principles that have kept me and why I've remained so bullish on it. The first was when the Bank of International Settlements, which is really the central bankers, changed the rules and made gold a tier one investment. They didn't do that just for some paper exercise. It was a signal that central banks, at least, were going to become more interested or ownership of gold. And it turned out to be true. That's the single biggest reason for this dramatic rise that we have. Just an ordinary amount of physical buying, sustained buying. And let's not forget when you go back to that time when you talk about 25 years ago, they were big sellers of gold. So that has been and continues to be the single biggest factor. The second biggest factor that kept me involved is in the last several years, I became a believer in the movement of the BRICS, that it would become a substantial part of the world on trade and a player in the world economy. And ironically, many of those same central banks who had been buying gold were also part of or thinking of joining that group. And the discussions, and I've never been in the camp that they were about to introduce some gold coin or some type of change, but the discussion always has been that within 3 to 5 years, something that I said 2 years ago, so we're 1 to 3 years away, they will start to formally trade and use gold along with their currencies to settle their trading. They've already kind of tested certain systems to bring that into fold and all. But the big news was of gold becoming that tier one investment. And then the third thing now that, of course, has really enlightened or at least brought the mainstream financial media to talk about gold. Because let's face facts, Mike, you've been in this a long time. Wall Street and the media that's tied to their hips treat gold like kryptonite. They don't really want to go near it. They don't want it because if it's doing really well, normally what they kind of make their livings off, stocks and bonds aren't. But they began to even talk about this tremendous amount of shifting of gold and deliveries. And let's not forget, we've had 33 countries over the last 7 or 8 years repatriate their gold that was once held by New York or in London. And the cherry on the top right now, to me anyway, and I've talked about this since he first brought it up, is when Trump brought unsolicited into a discussion, hey, is there any gold still in Fort Knox? I still beat my head trying to figure out why would you bring that up unless there's something behind that that's going to be part of something you think is going to have to take place. Now, there's always been a conspiracy group and people who have, claimed that, if it's there, it's been lent out hundreds of times. There's several owners for each bar, whatever the case may be. So all these things, plus general fundamentals, values of the dollars declining, these issues with tariffs and wars, have all made gold a very sustainable and most likely moving higher over time. And no reason yet to think that for any reason I have to long term maybe start considering that it's reaching a peak.
I can't disagree with you. We're living in, as the Chinese would refer to it, interesting times, and gold always seems to do well when things are unsettled in the world, shall we say. I even look at the U.S. debt load. One of the things that President Trump ran under, and he brought Doge into control, was government spending. Yet, just last week they bumped up the debt ceiling again, and they're on pace to having a deficit as large as Biden's last year in office. So, government spending is certainly not dropping anytime soon. And I'm wondering if that's going to put more fuel under the fire of gold. But it's had a 33% move since in the last year. And, I gotta wonder where it's going to, break and start to consolidate that move before it takes that next leg up. And, I have similar concerns to you, whether it should be sooner than later.
Well, let me just say this to you, and I've been talking about this in recent days. And let's not forget that here in the US, the average financial advisor, almost 45% of them now weren't even born when I started in the business in 1984. And so they may not have any recollection of what I'm about to bring up, but it's important. When I started in the early 80s, Mike, the Dow Jones Industrial Average for 27 years traded between basically 700 and 1,000. And in the early 80s, there was bearishness across the board. The Soviet Union, nuclear war, Arabs were going to take over the world, not the Chinese. The Japanese were going to take over the world. All sorts of negative, and there was no real bullishness on Wall Street. In fact, a famous Business Week magazine front cover ran said that equities are dead. And a young man that no one knew of, a little bit older than me at the time, named Robert Prechter Jr., came out of Gainesville, Georgia, and said the going to 3,600. And people said, how could you even think about it going to 3,600? It's never really gotten over 1,000. And he explained it away in an Elliott wave theory, which not most people didn't know about. It was a special type of technical analysis. And long being short, not that it only go to 3,600, it went to 40 something thousand over several years, obviously. So I don't think we should take and say that gold can't get to a number, because those same people said that about the Dow Jones Industrial Average. Now, I was never in the camp, Mike, when people 10 years ago, 10,000, 20,000, because my line was, if we went from 800 to 10,000, whatever happened in the world, we may not want to be living in it, even if we own the gold. But it's now legitimate because of the things we just discussed, that we could see, especially if gold is going to be used not only by these BRIC nations, but clearly, Mike, I think what people need to ask themselves, and your listeners need to, is these central banks don't have anybody to trade this to make money on. In other words, I don't think there's going to be such a euphoria among investors that every human being is going to want to own it so the central banks can sell it back to them and lock in the profit. They were acquiring this gold because they knew that they were going to have to use it sooner or later to reflate or restructure the tremendous world debt that exists. And I don't know if that's 1 year away, 10 years away, whatever that may be and all. So we're not going to see their gold coming back into the market just because prices went up. So, like I just said, and maybe to cap the gold discussion, is yes, correction and consolidation, the sooner the better, especially if you want higher prices. But fear of anything past that corrections or the top is in, no, there's nothing on the horizon to suggest that.
And for the mom and pop who may be just first buying their first gold medallion or coin, they should probably wait for a correction before they do so right now, then, is what I'm hearing you say.
Well, that's always on a case by case basis. I always learned the best thing to do is, if you think it's a good buy, but you're not certain this is the time, put it some to work now and then put it up on a scale up or a scale down. In other words, if it goes lower each time it reaches a level, I buy more. If it keeps going up, I buy more. But at least establish a position. And, part of the thing that has happened here is, and that I hear from people now, is, wow, I remember you saying it was 1,800. I wish I bought it. Then I remember you saying, I wish I bought it. I always tell everybody, wishing and hoping, especially hoping, is a wonderful spiritual strategy. It's the worst investment strategy. You have to make a formal decision and stick by it. So I would say, yeah, if you feel it needs to be part of your portfolio, you need to own some of it now, and then whether it gets a little bit cheaper or more expensive, then you think about adding to it.
Yeah. So that's gold. Then there's what they call poor man's gold or the devil's metal. That's silver. Silver's lagged. Typically, you have a gold silver ratio that's around 60. It's upwards of 88, 89 right now. That means it would take 88, 89 ounces of silver to buy 1 ounce of gold. Do you see the silver market ever catching back up to gold again, or is it an outsized opportunity going forward from here?
So, Mike, when I used to do the shows, and even in recent years, right up till today, my answer to silver was, and I always got the silver bugs mad at me, silver is like kissing your sister. So there's nothing yet to suggest that it's going to outperform gold in a dramatic way. So my suggestion, at least in our planning group, is own gold first. Yes, you can own some silver, but don't expect it to lead until it at least breaks through this barrier, which is forever the barrier, and it's in the $35, $36 area. Be willing to pay up a little bit more, but once it does, it really shouldn't stop then. It could actually then start to lead gold. And we can spend all sorts of time. There's people who spend all day on the internet about it, talking about suppression and this and that and all. And whether it's true or not, the bottom line is it still struggles. It hasn't broken out big time like gold has. And I think you wait till it does and pay up more for it, but be fairly certain it's not another failure of reaching a peak and then turning back down. So it's always second fiddle for me. And that'll, of course, believe me, I get them all the time. There are silver bugs just like there are gold bugs. It's not that I dislike it or have anything against it, but right now it's been a better choice for me at least to have gold than to have silver.
Well, gold is definitely the better insurance policy. So silver is always the kind of get out of Dodge. If you needed to run, silver could help you do that. But I can't disagree with you. Like one of the things I've noticed about silver and is historically when it's run on gold, it's almost a very short, violent turn to the upside and just as quickly right back down again. We had it hit its high at the same time as gold hit its initial high of 1900 back in 2011 or 12 ish times. But it was a quick shot up to $50, and I think it was back down again within a couple of days again. So that's always the way with silver. It's almost like a game of musical chairs, and you got to be ready to hop on and off that chair when it's time.
Yep.
The other major metal that's out there that's been outperforming this year is copper. I don't think there's anybody that's had $5 copper on their bingo cards for this year yet. Here we are, close to that. What is your thoughts on the copper and the industrial metals markets?
Well, Michael, you're meeting the guy that had bingo at five. So I was looking for $5, but not before till we got towards the end of the year. And so I've been pleasantly surprised how fast we got here. And as surprised as I am and as happy the fact that we got here and are bumping up now against some very important resistance. Here too, I think a correction and consolidation phase for anybody that still believes it can go substantially higher is in order compared to if it just reaches out some more here. It's getting quite overextended now. So, you know, the problem for especially someone like yourself that's been around, we have that old mentality of Dr. Copper, recessions, copper goes down, economies boom, you buy it again. The problem is back then there was ample supply of it. So, whether, you didn't have to worry. The problem now is if we're going to reach some of these numbers that people were talking about, whether it's the electrification argument, which is cooled down but still going to move forward, the AI, the amount of data centers, military, a whole bunch of stuff. And the fact, Mike, that one of the big changes, and I know the last question we're going to have after this is about mining, it's not as easy to go find it because a lot of places that you used to go, you don't go out of safety or political, or it's too expensive and it's too low grade or too high capex. So the copper argument that you made 20 or 30 years ago on when you should buy it and when you should sell it has changed dramatically. But still, even with that, here above five and how fast we got here. And I was telling people at the beginning of the year, under four, if we get to five at the end of the year, it's a great move. Well, we got here in 10 weeks. So yeah, calm down, go into a trading range. I'm more in the camp that believe one day it will be high enough. I'll tell you this much. In order to sustain what the amount of copper that many are predicting needed over the next 10, 20 years, it's going to need a price substantially above five and to stay above five before major companies are going to sink the billions and billions of dollars. Remember, copper is normally a labor intensive and high cost metal to get out of the ground and develop. That's why these copper gold deposits, especially where you can use the gold as the starter and capex can be so much lower, are becoming such primary ones. One of the reasons that my two biggest personal holdings are companies that both have a copper gold equation that's almost 50-50. And so, yeah, copper, great run. Best to have a little correction consolidation phase. But anybody that thinks it's going back to 2 or 250 or even three, I think is going to be mistaken.
Okay, so even the consolidation won't be that big of a correction before it starts to move again.
Michael, I think
Um,
the bottom, I'll just say this. I think the bottom is where we started from. Anywhere from 385 to four would be and that would be with the economy in the worldwide just almost shutting down. Then I could see it be back to that, but I don't think it's going to get much below that. And I just think people have underestimated how much more we need and how much harder it's going to be to get that amount. And they're just starting to realize it now. And that's another big argument for another day, Mike. But this critical mineral battle, especially with this tariff war, and here's great Canada and the US. And to me, Canada was a home away from home for me. And now we're in these battles where it's, bullying this way and that way and all this other stuff. The metals have an underpinning now that didn't exist 20 or 30 years ago. And that's another fact that we have to, those of us that go back that long, have to change our thinking mind because of the real need for these critical minerals. And nowhere is there the ample supply that used to exist.
yeah, now the other challenge as we look at critical metals is resource nationalism. You're starting to see some of these countries that are taking back mines away from mining companies again, and actually wanting fair price for the minerals that are coming out of those mines. And I see that also as being some headwinds that could be, taking like the price of copper and moving it forward as well.
Well, my investment is only North America. I won't go south to Miami. So I am not taking political risk. I'm trying to take it off the table. It's not to say that I would want to be building a mine in California, which I don't think is going to happen. But I do think by and large, the world has shrunk dramatically for the mining industry on where we can go and still put our head on the pillow each night and sleep easy.
Yeah, I try and stay away from country risk myself. I remember I was at Beaver Creek last year and I was brought into a meeting, and it was an Australian company. It had some mines in Zimbabwe, and there was a gentleman from country there. So I asked the elephant in the room question about political stability. And I got an honest answer from the gentleman, not necessarily reassuring or the answer maybe I was looking for, but I asked him about the political stability in Zimbabwe, and he said, "Oh, it's perfectly stable. We've had the same dictator for the last 25 years." So again, didn't necessarily give me confidence, but it was a true answer.
Yep.
The miners themselves. Without the miners, we don't have the commodities, and these shortages are going to get worse. And you've got this bifurcation that's happening in the world, yet the mining stocks themselves seem to be lagging behind. Now, I'm noticing that the stock market in general is going through a correction or a repricing. Are we going to start to see some of this shifting over and out of, say, tech stocks and into mining again? Or, is there going to be another catalyst that's going to, pick these miners up and get them going again?
So there's two different groups. We're going to first talk about the majors, the big producers. They've become printing press. The Agno Eagles and some others for the next several quarters are going to have just record free cash flow at a time when mainstream Wall Street's going to be challenged to find any other sector that will see the type of growth and earnings that they're going to offer. And that's what's going to bring the generalists who have been avoiding the mining stocks in general and playing the techs and everything else and the crypto and all into those stocks. They're already doing that. They're seeing that. Then, of course, that leads to the mergers and acquisition because their paper is getting strong, and we're starting to see that lifting up on that front. The $64,000 question that you hear, especially from retail investors, is when the heck are these junior resource stocks going to go? And I think there's a long-winded answer, and it needs to be my last answer to you today, but I think it's important I give it to you. 20 or 30 years ago, I will argue that the junior resource market was bigger than it is now. One, we used to have hundreds, if not thousands, of individual financial advisors, we would call stockbrokers many years ago, who built a part of all their book of business around buying and selling juniors for their clients. And so if you got one of those financial advisors on board, you got 50 to 500 of their clients into your stock. Well, they're dinosaurs. There may be a handful of those people left, but because of no commission, basically, that is an irrelevant and no way of running a book of business. And so even if all those same end users, those clients exist, which I don't think they do, I think it's actually a smaller pie than it used to be. Now that junior resource company has to find an alternative way to that end user. And there's no simple answer for them. There's no one other way that they could just replace those broker people and still get that interest. So that's one of the biggest challenges. It's not discussed in our business, but that's one of the biggest challenges and changes. Then on the institutional side, Michael, and you probably noticed firsthand, there's not as many institutional funds or mining desks or players that used to exist. You know, Toronto had dozens, Vancouver had a half dozen, London had a half dozen, Zurich. There's a handful. And, and most of them have not been funded in any way. They may have an older guy like me who's sitting on the desk maintaining what's left of the book, but there's no a lot of new money coming into that and all. And then regulatory. First, here in the US, a discount broker here now is banning people from buying unsolicited junior resource stocks that trade on Canada, even if they have an OTC symbol. And then the last, of course, is they made it difficult, if not impossible, to promote and market juniors because you can't sell any sizzle. Well, a junior really has only sizzle, certainly until there's a PEA or a major discovery and all. And then the last problem, and Canada's finally getting around to do something about it on its own side, and that is the length of time and regulatory and the hoops you have to go through if you are the 1 in 10 company that makes the great discovery and can build a mine, et cetera, et cetera. So it's been a very challenging, as you go down the food chain into the junior market, to me, it's much tougher, especially when you talk about areas of the world that you can't go into. Look, Mike, some people say it. I know a handful of people mention it publicly, but it's true. We could lose a third of the junior companies that are listed on different exchanges, and many of them are just lifestyle companies where they're kept afloat because the guy or gal that's running it, kind of lives off that, and they could disappear and we'd all be better off for the remaining companies, but they still exist. And so they are only going to see their day in the sunshine after we clicked with the metals movement, which has happened, the majors moving, the majors starting to do M&A, and then they're going to reach down to these companies because right now, for a major to go out and do grassroots exploration, when you take his wins and losses, the projects that worked and didn't, they got to spend anywhere from $150 to $300 an ounce gold to get that. Well, there's ready-made, understandable, well-defined projects in North America right now where the gold is being priced as cheap as $20 and no more than $50 or $60. So it's just going to be a log jam when that first log is moved and it happens. The junior market will light up, but it has a problem is it doesn't have the same interest. And one of those interests that was taken away is basically if they're 40 or if they're 35 and especially 30 or under, those people who used to come into the junior market for the first time went into the crypto market. And they're not leaving the crypto market because many of them become almost like a cult. So there's still a significant challenge for the junior end of our business. But I think even there, a lot of boats will be lifted now because of what we just discussed.
So, in your mind, then, will it take a major buying out a junior completely to, is that the log that needs to move to move the log jam, or is it something else?
I think it's a couple of big ones just coming together for people to realize how cheap and how desperate they need the resource. I'll give you an example. I'm in a camp that Agno Eagle has to buy I Am Gold, or these guys got to merge together. It's a perfect marriage now, or at least I Am Gold to sell the Cote mine to them so they can focus on their other things in Quebec. But it's movements like that that then will include juniors who may be in that camp and get consolidated and so forth. I think that's what's going to happen. We used to have area plays and land plays. Listen, there's still a handful of people left that were still out on the speaking circuit when I used to be, and there's a handful of new people, but it's an industry has not seen new blood or new interests or really life in the sun for very short times. And even when we do get a bull market, it's always a lot shorter than the bear market, Mike. So, but I think we're close. I think in the next 60 to 90 days, we'll see perhaps the biggest pickup in M&A in the metals and mining, and that's going to be the logjam that breaks out. And then hopefully, if you have, like I feel, projects that companies have, proven to be more than just, cow pasture, I think we're going to see a strong rally in that end of the market.
Well, your lips to God's ears. I'm looking forward to those days. Is there any particular place that people can follow your musings as
Yeah.
things go around?
Yeah, so I basically have now let X page become my main source of communication. So my page there. I also have a website, petergrandich.com. I also have a YouTube channel where I interview some people, and whenever I get interviewed, I place it up there. But my X page, still say Twitter, is where I do most of the bulk of my work now.
Okay, wonderful. We'll put those links at the bottom of the description of this podcast. And Peter, it's been an absolute pleasure to have you on, and I look forward to having you on again sooner than later.
Thank you, Michael. God bless you.
Thank you. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.